All right, welcome everybody. Today is Friday, October 25th, 2024. This is You've Got Options for Income Navigator. And today we are going to just review positions that I have on. If you have similar, same positions, or if you're just following along, you hopefully will get a slightly better idea about what it is that I'm doing, why I'm doing what I'm doing, and you get to ask questions if you have any. There's a chat box on Zoom in this meeting, so don't be shy. Do ask questions, and hopefully, I will be able to answer your questions and make things a little bit more clear. I did a couple of things today. So number one, the first thing I did, I um, made an adjustment to one of the trades. But before we get into that, so today being Friday, I did one of the short SPY put campaigns. I added a tranche. I am now selling puts in January 2025. This is Jan 17. I sold to open a 450 put, took in $1.35 credit, and I did post entry on Discord. So that's that. And then we're going to move on to a couple of positions that I have in SPX, right? So this is a portfolio margin account. And I'm going to talk about this one position that I've had on for about 73 days. And as you can see in this time frame, the underlying, which is SPX, has moved just outside of one standard deviation. Can't say that we're moving with a whole lot of speed, but we are on that higher end of what was expected back in August 13th. This was when this trade was put on. I made quite a few adjustments along the way, and this is where we are right now. And the reason why I wanted to talk about this position is a couple of things. So we have 21 days until expiration, and I would like to start to unwind positions at around this time. Um, I think it makes sense. And let's have a look at what we have. We have about $600 of extrinsic value, which means that over the next 21 days, the most I can possibly make, not assuming that I won't fall into this um, small little trap of death, right at around 59.20. But assuming that, the market is somewhere above, let's call this 5,100. The most I can possibly make over the next 21 days is an additional $600. And this trade takes up about $17,000 in a portfolio margin account. So we can say, well, let's just leave this alone, right? Let's wait another 21 days. We know that upside is, not as great, but considering that it only takes up about $17,000, it's not that big a deal. Now, if you are a member and you saw, I took down a bunch of positions in SPY that were pretty far out of the money. They were very close to hitting their target. These were short SPY puts. And the reason why I did so was to remove the risk because I felt that the potential reward wasn't worth the risk. I did not think that those puts were going to fall much further as far as premium goes, because as time goes and supposedly theta supposed to kick in, right, that time premium gets replaced with implied volatility. So essentially, we end up holding risk with no additional benefit. We would have to hold them at least through the election, and then we have to deal with potential fallout or whatever may happen, whatever the reaction is going to be after the election. We would have to deal with that. So we're not really gaining any benefit while holding on to the risk and potentially assuming more risk if something was to happen after the election. Kind of similar thought process here, right? Even though this trade has pretty big cushion, if you will, all the way down to about 4,500, right? So the market could fall as much as 20% from where we are today, and this trade is still isn't a terrible trade. However, this is one thing that a lot of people overlook, right? You can make the case, hey, if the market falls in the next 2 weeks, right, we can project T plus, let's say 13, right? This is November 7th after the election. And if the market falls down to about 5,000 on the S&P, we're down 837 points. Well, it's not terrible, right? Because we are now potentially are going to enter the trap and make this really nice bonus, right? The problem with this is that if you are holding this position in a portfolio margin account, right? Portfolio margin is looking up and down 15%. So you have to look at your new buying power requirement for this trade, assuming that we're at 5,000 on the S&P 500, and what will your new buying power requirement be if that is the case? So from 5,000 we have to go down 15%, and that's your new buying power. If right now this trade takes up $17,000 in buying power, if we were to fall, and I'm not even going to talk about volatility, but if we were to move down to 5,000 or 4,900 on the S&P, this position is going to go from buying power requirement of 17,000 to about 180,000. Right. So BP is going to 10x. And if you are even thinking about, right, well, if we fell down to, 5,000 or 4,900, great, I'm holding. Well, you better have the buying power that it'll take to hold this position. Otherwise, if that's not the case, and let's say if we do fall down to about 5,000, and let's say volatility jumps, because, if we're down 15% in 2 weeks, you could, um, you can make the case that volatility is probably going to go higher. We don't know by how much, but let's just assume that volatility moves up 30 points. And at 5,000, now this position is showing a loss of about $20,000. At 4,900, we're down almost $30,000. And your buying power requirement for this trade is now 180,000. It's going to be a little bit hard to hold, because what if we move down another 15%? Then you're in a whole lot of trouble. The good news is at that point, your buying power cannot possibly increase by much, because this trade has a Reg T risk or Reg T margin of about 183,000. Right. So your buying power is no longer the issue. The issue is holding on to a trade that is kind of running out on time. And now you're racing against the time, right? You're racing against potential further move down over the next 8 days. And this becomes a pure gamma play, right? If we move down, gamma is going to push delta higher. If we're selling off, you're accumulating more and more positive delta. Therefore, your losses on the way down are going to start to accumulate. You just don't really want to be in that mess. Now, my one idea is to, if we are going to hold this position a little bit longer, and we are going to assume that if we trade lower, we want to hold on to this position. What I think makes sense here is to remove half of the put credit spreads. They're pretty far out of the money. So the 50, the put credit spreads are at 45.50, 44.50. So this is a 100-point wide spread that is currently going for about 32, between 30 and 35 cents. So if we were to take this, right, half of this put credit spread off, what happens is we give up about, on a 10 lot, we give up about $300 of the extrinsic value. Okay. That's not good, right? We don't want to give anything away. But now, new buying power requirement for this trade is only $5,000. So we gain back about 12 out of $17,000 in BP, which is the good part, right? So it's only costing us $300 in extrinsic value to gain back, a big chunk, 80% or so of buying power. And if we were to play this chicken game of, what if we do come down to about 5,100, 5,000, maybe 4,900, our right position is going to be at a smaller drawdown, which is a little bit easier psychologically to hold. It's still not a fun game to play in the last 8 days, right? To race against the time. But drawdowns is much smaller, and BP could only expand to the max of about 85,000 or so. Right. So it could be much easier to hold if we are going to play that game. So the idea here is to buy to close half of the put debit spreads for about 30 35 cents, gain back a big chunk of BP, and remove a big part of the risk. And then we can hold it for another, 3 weeks. And now we only have, instead of, $600 of extrinsic value, if we're paying 300 to make this adjustment, we only have about $3 more to make over the next couple of weeks. Right. So that's the idea. To buy to close the 44.50, 45.50, 44.50 put credit spread for about 30 cents. That's that. Let's talk about the position that we did adjust earlier today. This is trade 29. So the trade we just talked about was 2933. This is trade 3003. And this is what it looks like now. Maybe we did jump the gun a little bit and made an adjustment right at the market high of the day. So we essentially top ticked the market today with this adjustment, but this is what it looked like before making the adjustment. Right? We're sitting right underneath the graph at expiration, which has a max potential reward of about 1250. When I made this adjustment earlier today, this trade was showing a P&L of about plus 800. So what we had, our delta is, it was under 2. Right. So essentially, we're holding a bunch of risk and we're not really gaining anything, or, our reward is decreasing with every passing day. So what I decided to do is I decided to roll the wings in. Right. I rolled the long. Let me go back here. I rolled the 55 down 30 points. And simultaneously, I rolled the 53.65 up 30 points. I collected $1.40 for this roll, and this is what this new position looks like. So $1.40 on a 10 lot. I had brought in an additional $1,400 of premium. So now if I'm going to continue to hold the risk, at least I have more potential reward in exchange for that. So I had increased my delta, so I am taking more directional risk, right? I increased my delta from about, let's just call it 2 to up to about 8. Still not a whole lot of delta, right? For a 10 lot butterfly, having a plus 8 or 9 delta is not a lot. So this is what this position looks like. Now with the market pulling back a little bit today, and I'm not sure if volatility is rising, but both, if that is the case, both are working against us, but it's not that big a deal because now from here on, I want to leave this trade for the next 3 weeks. And we can, project what it would look like at, maybe T plus 19. Right. So if we are going to see move lower, it's not in our best interest. If we do see a move higher, right, we will have made a big chunk of our max potential reward or tail profit. And at that point, we can decide with 37 days to go if we're going to do something else to it to increase our reward. Because as you can see, at T plus 19, and if we are at 6,000 on SPX, right, this trade will show, let's just call this a P&L of plus 2,200. Our max potential reward is 2,650. So we only have a couple of $100 left with 37 days to go. And I think that at that point, we need to make a decision if we could find a better way for the use of, whatever buying power is tied up in this trade. Right now, I believe that this trade is taking up on a 10 lot, it's taking up 23,500, maybe a little bit more since the market is pulling back a little bit. But, you know, um, if we are at 6,000 in 3 weeks from now, buying power requirement is going to decrease. And whatever that buying power is at that time, we need to figure out if we can use it elsewhere to generate more than just a couple of $100 over 37 days. So that's my reasoning behind potential adjustments. But for right now, I think this trade needs nothing unless we start to really push back. And, to measure when to make an adjustment, we can look at the delta of the long leg of this put debit spread. Right now, it's at 22. If it gets to about, maybe 35, right? We don't want to wait too long because the longer we wait, the more expensive adjustments are going to become. So right now, the long leg of the put debit spread is at 22. Over time, it's going to decrease. And if the price of the underlying is going to go higher, the delta is going to decrease as well. On the flip side, if the market is pushing lower, if volatility is rising, deltas on the long leg is going to increase. And when it gets to about 35, I'm going to start to look for ways to potentially flatten out this T+0 line, right? Because as you can see on the way down, it's really going to start to slope. And then because this is a short gamma trade, this means that on the way down, we're going to accumulate more and more positive delta, which means any further move down, right? If our delta is becoming more positive and the market's moving lower, the rate of our losses is going to start to increase. So we kind of just want to figure out a way to flatten out our T+0 and just, buy some time. Of course, it's going to probably, and most likely it's going to be a debit transaction, which will take away from our potential reward in the tail. And then we'll potentially look at ways of replacing any debits that we may pay to slow things down and buy ourselves some time. Best case, nothing happens. We're somewhere, right? This darker shaded area is the expected move over the next 19 days. And if nothing happens over the next 19 days and we're somewhere inside of this darker shaded area, all good. We just need to burn some time off the clock. And right now we have a lot of it. It being the time. We have 56 days. A lot can happen. So for right now, we're just going to leave it alone after this adjustment and let some time burn off the clock. So that's where we are with this position. And then we have the December 31st, which is 10 days in. We have not made any adjustments to it. It's just doing nothing, right? 10 days went by. The underlying is essentially unchanged in the last 10 days. This trade really needs nothing, right? We're in a decent spot right now. And, like I said in our last meeting, that with these kind of trades, we put them on with plenty of time until expiration. And then what the first thing we want to do is we want to let some time burn off the clock. We want to let the put credit spread decay and the put debit spread is going to decay as well. But because the put credit spread is a wider spread, it has more theta, and we're short theta here, and we're short vol here. In the perfect world, this put credit spread is going to lose value faster than the put debit spread, and that's where we get the benefit, right? So if we let 30 days run off, it's been 10, let's add another 20, right? This is essentially what this trade should look like at T+30, right? If 30 days goes by and we're somewhere inside of the expected range, this position should show a positive P&L. And then we need to make a decision what we're going to do, or if we're going to, roll the wings to increase potential reward. Because if we are, let's just, call this 5,900 or maybe 6,000 on the S&P with 47 days to go, and we're maxing out our tail profit, then we are essentially holding risk with no potential reward. So we need to figure out if we're going to stay or if we're going to go. Right? We can stay, do nothing, which is not my favorite in that position. We can go, take profits, and move on to the next trade, which is okay, great. Or if you want to stay, you need to find reward. You need to find a reason to stay. You need to justify risk for continuing to stay in this trade. Hopefully that's clear. Right. So these kind of trades are very, low maintenance given that the market isn't, freaking out and, we're not all over the place. And you can tell by the, shape of the T+0 line is that we don't want drastic moves, especially to the downside. We just kind of want the market to do nothing, right? We can go up a little, we can go down a little, but in the perfect world, this trade needs first 30 days, volatility comes in, and we get to a point where we're showing a decent P&L, and then we need to make a decision if we're going to stay. Then we need to figure out how to bring in a credit while controlling the risk to the downside. Very easy trade to manage if the market is somewhat normal, right? 90% of the time, the market is not crashing. So if the market is not crashing, we're just kind of trading up and down, up and down. This trade benefits from that kind of price action. So that's for the couple of positions that I have in the SPX. If you guys want to look at positions that I have in ES, I'm going to switch over to, I'm not going to talk about the CL position. We talked about it earlier in the week. Let's see, we have the 11X. Right. These are the same exact thing as 112, except we split short puts from the put debit spreads. And that is the new 11X trade. David is asking, can you give an example of bringing in a credit to protect the downside? You will never bring in a credit to protect from the downside. And that's a really good question. Let me go back. Let me go back to that. Either one of those two butterflies will be a good exercise. Let's look at that's not it. Hang on one second. Let me switch back over to, let's look at this one because this one has a little bit more directional risk, right, on the way down. So if we're talking about protecting from a downside, we could never bring in a credit to protect from the downside. And the reason for that is if we are going to get the benefit, right, of protection, we cannot receive a credit. Now, I know that you could probably make the case that, if we're just trying to fix our delta problem, right, we can sell calls and that will bring in a credit. And let's see what that would look like. Let's assume that we are now in a position where we needed to do something to defend this position. And because the Greeks are so light here, I'm going to try to make this best I can. So the first thing you can do is you can say, well, if I'm long 9 delta in this position and I wanted to flatten it out, why don't I just go ahead and sell a 9 delta call? That would make sense, right? We're plus 9 on the position. If we sell a 62.30, just one call, this will take my delta to essentially flat. And that's a bad argument for fixing our downside problem. Reason being is that, yes, we just flatten out our delta. So essentially, any further move down isn't going to hurt as much, but our T plus 0 is still going to point lower, which means any further move down will put us in the position to re-hedge, right? To fix our delta problem yet again, right? Because we're still short gamma. So selling calls, and this happens a lot. I see this when, especially in retail trading, when you have a problem on the downside, selling calls just because you're bringing in the premium isn't always the best thing to do. Because if you think about, if the market is crashing, let's say the market went down 15% and you have a ton of positive delta, selling calls to remove that delta exposure, you're essentially shorting the market in a whole, right? After the market has already went down. So selling calls after the market had already sold off, you're now introducing upside risk, and you're doing it in a probably one of the worst possible time for that adjustment. Um, so selling calls isn't really uh, fixing the downside problem. Yes, it would bring in a credit, and if you, again, it's not the worst thing to do. You can do it, but you have to understand it. Now you have upside risk. So if the market sold off, you sold the calls, and now the market is reversing, going higher. Now your downside is still it's getting better, but it's still not out of the woods. But now you're getting your short calls, to light fire under your butt. So that's not really my idea to make an adjustment. An adjustment to save or to protect from further downside would be to buy premium, because long options have positive gamma, which means that our T plus 0, right? Our goal is to flatten out our T plus 0 line. And the only way we can do it is by, yes, sure, we can do some calendars, but calendars also will only hold to a certain extent. And now you have to worry about different implied volatilities across different expirations. And I think it's just, a little bit too much. The easiest thing to do would probably look at like, maybe 30 delta options. And let's say I needed to shave off 9 delta here. So I would go to a 30 delta put. I'm buying one 30 delta put, and now I need to sell a 21 delta put to make it a 9-point difference, right? So maybe I'm going to go and sell one of these. Let's see what that looks like. -1. Right? Essentially, I took my delta from +9 to about 1.3. So I removed a lot of my downside risk. And now you can see with my new T plus 0, it's essentially flat. But there's always two sides of that coin. We're removed, and you can see that this green line here is my new T plus 0, which is pretty flat on the downside, which means if the market continues to sell off, right, I don't need to jump and do something about it. I'm okay with fairly flat. And you can see my deltas. And there we go from, if we sell off down to 5,700 on the S&P, my delta is only 3. We sell off to 5,600, my delta is about 5.5. But if I don't make this adjustment, you can see how my deltas are going in the teens, right? So by buying a put debit spread, I will remove my delta, and then on the way down, my delta isn't accumulating as fast because my positive gamma from this put debit spread is offsetting the negative gamma of my original trade. So the trade-off here is that we removed some of the downside risk, but guess what happened to our tail profit? right? We just gave up. If we were to do this today and we did one of those, right, this is going for about 1,900 bucks, which means from our tail, which is currently 2,650, we're taking 1,900 from this 2,650, and that's what we're paying for this downside hedge that's going to remove the risk to the downside in the event the market continues to push lower. So if the market continues to push lower and then we see signs that the market is kind of starting to find balance, maybe the worst is behind us, the market is not crashing, but we're just pulling back, we can leave this on, or we can figure out ways to once again recover the $1,900 that we would be paying for that hedge. But we're just kind of getting a little bit too far ahead of ourselves. I like to kind of just go one step at a time, understand what we're doing, what we're trying to accomplish, how we're going to get there. And then if we need to reverse, sure, we can sell this put debit spread. It's not going to be trading for $1,900. Maybe it's going to be trading for less. And maybe we sell it for $1,600 and we just lost $300 on that hedge that we bought. So now we just need to figure out a way to bring in an additional $300 to get us back to where we were before we were forced to hedge this position. All right, so that's the general idea. Time Merchant saying, would you use a debit to protect? That is the only one way. If you want to do a credit, I don't think there is a way without introducing a whole lot of risk somewhere. It could be further down. It could be, again, to the upside, which is not really my favorite. A good example would be, imagine if you were, around early August as the market was pulling back and volatility was rising, right? You were accumulating a ton of positive delta. If you wanted to remove some of that delta, you sold calls instead of buying puts. The market bounced hard, and then you're getting run over on the call side, right? So it's very tricky, and I think it's misleading. And this is also one of those, you can apply the same thought process to the process of roll the untested side. Like if you are in a strangle and the market moves towards one of the short strikes, you roll in the untested side. Guess what? Right? You're just moving your, let's say if the market went down and you roll your calls lower, you just, sure, you brought in a credit, but you also moved your break even on the upside much closer at the money. And if you see a pretty sharp rebound, now you could potentially, you increased the odds of getting run over on the upside by a ton. And now if your calls are getting tested, you would think, oh, I'm going to roll my puts. But if those puts haven't fully recovered, now you're locking in losses. So you just end up, putting yourself in this spiral of, I think it's a terrible management technique. You can do it, right? You go inverted and all this, but essentially, you could call this rolling, but you're realizing losses, or if you're rolling in untested, you're realizing a profit, but now you're in, you're selling calls much closer at the money after the market had already sold off. You got to think about if you weren't trying to fix your strangle, would you be initiating this trade as a new trade? Probably not. So in my opinion, it's just not worth the hassle. So that's the idea. On the downside, we are just trying to, so let's, focus on what we're trying to accomplish. Our goal is, we don't really have to worry about the Vega here. Yeah, it's going to suck if, the market sells off hard and volatility increases, but we don't have a ton of Vega here, right? Our problem here is Delta, because Vega is going to revert at some point. Delta doesn't have to. We can go into a downtrend for the next 9 months and end up somewhere way outside of structure. So if that is the case, we at least want to slow things down on the way down, right? To buy ourselves some time and figure out, hey, maybe we need to stop out of this trade at some point. But, in order to avoid having to do that prematurely, we at least want to slow things down. And by removing as much delta as we can, we actually buying ourselves the time. We're slowing things down where we can think a little bit more clearly about our next steps that we need to take. All right. So that's what I have for, and similar technique I would be applying to the other butterfly, right? Where long 5 or 6 delta here. And again, these numbers are so light that, um, but when we get, let's say, down to about 56.50 and we're plus 12 delta, then, again, I'm just going to use very simple. I don't want to use ratio spreads and overcomplicate things or calendarize things. You don't need to do any of that stuff. Look, your delta is plus 12. Find a put debit spread where the difference in delta between your long leg and the short leg is 12. Right? If the difference is 12, your long 12 by buying a put debit spread, you're adding negative 12 delta. Your net delta, your new net delta is going to be close to zero. What does that mean? That means that you no longer are exposed to one side or the other. Now, granted, if the market continues to move, yes, your delta is going to change, right? Because the delta is dynamic in these trades. But it's going to be the difference in the delta is going to be so insignificant that you will have the time that you need to figure out if the market is going to continue to move lower. You can look at the price action and decide, if we're coming into some potential level of support, or if you're seeing signs that the market is reversing. But you just need that time, and your losses on a day to day are going to be much smaller, which will allow you to think a little bit more clearly. Time Merchant's asking, is there a limit to a number of adjustments I would make before I hit stop? So, I know that in general, as a rule of thumb for me, is that, if I'm trying to make, maybe $1,500 in this trade, right now, when I take this trade, my max potential reward, and I'm not counting for, the potential reward inside the structure. My max potential reward is $1,800. Right. So maybe I'm trying to make this $1,800. Maybe I'm going to try to make a little bit more if things are going well. But on the downside, if my max potential reward or tail is 1,800, like I don't want to lose, $10,000 here. So what's a reasonable number? Maybe it's 2,000, maybe it's 2,500. It all depends really. But you have to have a number in your head, right? At what point do you just say, you know what, this thing is getting away from me? Because let's not forget, when we took this trade, our price outlook, based on what this T plus zero line is telling us, our directional outlook is stable. Could go up a little, go down a little, but we're not anticipating a crash, because if we were anticipating a big move to the downside, probably wouldn't want to take this trade. So if our initial price outlook was stable and the market is, down 7% in 2 weeks, well, the market isn't stable. So you need to go back and say, hey, was I wrong on the assumption that the market is going to be somewhat stable? If that's, if that's the market's way of telling you, hey, you're wrong on your directional assumption, this can go one of two ways. You can say, okay, market, I'm going to listen and I'm going to stop myself out and rethink. And I think that's the right thing to do. Or you can go in a way that probably 70% of retail would go and say, well, I'm going to fight this and defend this and adjust this until I prove myself right. And that's the wrong way to do this, right? So you have to have a number in your head, write it down as part of the trade plan, this specific trade. At what point do you just pull the plug and say, all right, this thing is getting away from me. I'm not going to make, unlimited number of adjustments, because not only you're paying fees to make adjustments, you're also spending, this initial $1,800 to make adjustments. At what point do you find yourself adjusting this trade just to get to maybe a smaller loss in the end, or a break even in the best case? Right. So you have to have a reason to continue to adjust. And you have to have a number. At what point do you just pull the plug and say, all right, I gave this thing a chance. I tried to defend it. I tried to slow things down. Clearly, the price is getting away from this structure. It's a lot easier to get off this trade, wait it out, because again, the market doesn't crash most of the time. There are going to be plenty of times when the market is going to be stable, it's going to be trending upwards. Maybe it's trending downwards, but in a stable sort of fashion. And these trades could make you money if the market is lower, but stable lower, right? Controlled move lower, not crashing. And if the market is crashing, then it's just easier to get out of this trade and wait for market to become a little bit more stable. And you could always put this trade, something else, you could put the risk back on. This is one of those trades that it's kind of hard to give you, okay, step one, step two, step three, if A, then B, if C, then D, because there's a lot of unknowns. So this trade does require some, you know, um, incremental adjustments, perhaps. And it also requires you to think like, I'm looking at this trade now. Here's where we are. This is how long we've been in this trade. This is what my risk is. This is what my max potential reward is. What can I do to advance this position to make it a better position for the next X amount of time? Or maybe I do nothing and just wait, right? But you have to kind of revisit, think about, is there something I can do? Like if the market for some reason, becomes more bullish than you initially anticipated, you can say, okay, I'm staying in this trade, but now I need a little bit more reason to stay in this trade. I need to bring in a credit and maintain bullish. So if you think about it, how do you bring in a credit and maintain bullish? The only way I know, and this isn't, without going, as far as buying out of the money, put butterflies, blah, without all of that. The simplest way to be bullish and bring in a credit is to sell options naked or spreads. We don't want to do anything naked here. So my idea would be sell a put credit spread. And one way to sell a put credit spread, I take my long leg of the put debit spread and roll it down. Right? This reduces the width of this spread, brings in a credit, and essentially it increases risk a little bit. And to avoid going over my planned risk, I usually drag my downside long puts, just like what I did earlier today with um, the trade 3003. Right? I rolled my longs down. That increased my tail profit by $1,400, but it also increased my downside risk. So what I did to keep my downside risk in check, I rolled my longs on the downside up 30 points as well. So that's what yeah, and David is saying at some point, accumulation, commissions and fees is going to be considered. Sure, you have to consider all these things. Like you can, micro adjust this trade until you have no more premium to spend on your adjustments. So we kind of want to be, proactive, but we don't want to, adjust every single day. The reason why I enjoy these kind of trades is because most of the time when market is not crashing, you can put this trade on, and you can sit on it for 2 weeks, for 3 weeks without doing anything. You check in on it maybe once a day, right? If you know you're going to spend the first 3 weeks doing nothing, you're just checking in to make sure the market is not crashing. You don't even have to like watch this trade tick by tick, right? Which kind of breaks that chain that we're all tied to our computers with. And, we are able to go on about doing whatever we enjoy doing and just checking in on this trade. Does it need anything? No? Okay. See you tomorrow, right? Very easy to hold. All right. Let's just have a quick look at positions we have in ES. We just talked about it earlier earlier this week. Not much has changed. with the market bouncing today, these positions have improved just a little bit. I did harvest a few 1-1X already. So we have the, and these trade numbers are easy to find. 25 UCT, 30 UCT, 31 UCT. All these have now, so these three tranches have become the hedges. And this is what this, and this is part of the build the wall process. Right. So these leftover put debit spreads with 100 plus days until expiration are going to essentially provide hedges for, right? I have two of the most recent X trades. And this is what these two look like. So this is the one with 10 days. 10 days since we put them on. And then we have another one, which is at, this is 2 DTE. I'm sorry, 2 days in the trade, showing a slight loss. The market is up a half of standard deviation from when I put this trade on, but volatility is up. So that's pushing T plus 0 line down a little bit, but not a big deal. The goal for these trades, as we know, we have the front month. This is where our naked puts are. That's the income part of this trade. The put debit spreads that have a lot more time until expiration is the hedging part of this trade. And as the front month or the short naked puts are rolling off, this leaves us with the leftover put debit spreads that are going to be part of that wall that we're trying to build. So that's for the 1-1X trades, and then I have a couple of 1-1W, and the 1-1W is the one that is it's a 1-1-1 structure where I am willing to take an assignment, and a W will mean for the wheel, which means that if I do get assigned, I don't want to get assigned, but if I do get assigned, I will have to figure out a way to wheel my way out of that position. So this is a 15 DIT, days in the trade. This is 15 days old. And we have another 1-1W, which is 7 days old. And we can put them on every week. You have to plan for it as far as your buying power goes. I'm gonna probably do these trades every other week until I have a really good portfolio of leftover protective puts. Maybe add some delta hedges. But again, I don't want to spend too much on these delta hedges. So if I can figure out a way to generate these delta hedges and have them fully paid for, then I don't have a problem with increasing the frequency in these trades. So for right now, I think I'm going to space these 1-1Ws every other week, and I'm going to add 1-1X trades every week. And that's, pretty much it. I mean, I want to keep it as simple as possible, right? We're going to, run this for a couple of months, and then I'm going to make a summary of, how these have done over the last, whatever. And then we're going to continue to review them every couple of months and figure out, if we need to make any adjustments, if we need to change some things. For right now, I keep my 1-1X put debit spreads at about 100, 200, maybe 250 points wide. I think that's a pretty decent size for that put debit spread. Essentially, I would like to have a wider put debit spread. The problem I have with that is that if we go wider on the put debit spread, they would have to be further out of the money. And I think that if we put our put debit spreads too far out of the money, while they are a decent delta hedge, the market doesn't crash most of the time. So if my put debit spreads are, 20% out of the money, they will only work for me, or they'll only help me if we have like a COVID crash type of a move. But again, we don't normally do what we saw during COVID, or right, 5%, 10% pullbacks are normal, right? So I don't want my put debit spreads to be too far out of the money. And in order to keep them close enough to where the market is, right? Maybe 7% out of the money, maybe 10% out of the money. The wider we go on the put debit spread, the more it costs, which means that I need to get more aggressive on my naked puts in order to generate the income and pay for that put debit spread. So there's a balance that we need to find. For right now, I'm going to continue with what I'm doing. If I find something that makes more sense, if I find something that doesn't make sense, whatever my findings are, I'm going to let you guys know, let you know what changes I am making to what I'm trading. But for right now, this is it. And I hope that I gave you a little bit more insight and something to chew on and think about. If you do have questions, you can post them on Discord. I would love to have a conversation and, explore some of your ideas. And I think all questions are great. There's no such thing as stupid questions. So don't hesitate to ask any questions. So with that said, I'm going to let you guys run. Have a good weekend. Thanks for joining me today. We'll be back next week. And in the meantime, if you need me, you can find me on Discord, and I will talk with you guys next week.